Okay, the next report is ratio analysis. You might be thinking that ratio analysis is going to be really a very good and helpful report to you, but I have my own doubts on it. The reason being, ratio analysis is based on the groupings, and the accountant is not having the sufficient knowledge that he ends up creating a correct group. So you can rely on the ratios only and only when the grouping of the respective ledger accounts is correct. Let's first see what are the different ratios, and then we will discuss in detail that why grouping is important. Here we have some details of the sales, purchases, debtors, creditors, etc. And on the right hand side, there are some relevant ratios which have been worked down on these figures. We have a current asset ratio. Current asset ratio means current assets to current liabilities. That means short term assets to short term liabilities. Now this is showing us 4.26:1. अब इसका मतलब ये होता है कि for every 1 rupee of liability we are having 4.26 rupee of liquid asset. Now the problem is, if by mistake at the time of grouping of these ledger accounts, if the accountant has by mistake grouped a long term asset, that means a long term advance or a long term investment, as a short term loans or short term advance or short term investments, then this ratio will give you a wrong figure. Hence, grouping is important. Quick ratio means highly liquid asset to liquid liabilities. Again, here, if the grouping is not correct, then certainly this ratio will not make any sense. Debt equity ratio. Debt equity ratio means the loan as against the owner's fund. And if again the loans are not correctly grouped, in case of loan, probability of a wrong grouping is little less, but still again relying blindly on the ratios is not advisable if the accountant is not capable enough to have a correct understanding on the correct groupings of the ledger account. Gross profit 8.78%, and again here can be an error if any direct income is by mistake considered as an indirect income, or a direct expenditure considered as indirect, or vice versa, then definitely it is going to affect your gross profit. Net profit is prima facie correct because here all the expenses and incomes are considered. So now 2.78% can roughly be considered as your net profit. Operating cost 97.22%. Again, it depends on the correct grouping, but if you're very sure about the grouping, then you should be the lucky enough that you have all this ratio ready-made available to you as against calculating it separately in the Excel. Receivables and turn, these all things basically depend a lot on the type of accounting and the knowledge of the accountant. Nevertheless, if you don't get the correct ratios here, certainly you can calculate the correct ratios using Excel. In fact, it is advisable that you should consider the audited financial statements and the groupings done in the audited financial statement in order to calculate your ratio. That will give you some sensible output. But this is all about the ratios. Definitely you should have a look whenever you get any tally data, but certainly you should not blindly rely on the same.